The US dollar strengthens after Trump says 25% tariffs will apply to Canadian and Mexican imports from next Tuesday. Markets are also focused on critical US inflation data tonight. New Zealand business confidence nudges up as interest rates fall, and weaker Australian capital expenditure may lower forecasts for December quarter GDP data. That's coming up in our 5 Things in 5 Minutes on Friday, February the 28th. And then in today's bonus deep dive interview, ANZ Economist Maddy Dunk looks at how much the RBA's rate cut last week might feed through to Australia's housing market later this year.
If you look at historical easing cycles at times when house prices have been falling, it's taken a while for housing price growth to actually pick up.
But first, in 5 and 5 with ANZ, the US dollar has risen sharply this morning after President Donald Trump confirmed 25% tariffs would apply as planned from March the 4th, which is next Tuesday. He also reiterated plans for an extra 10% tariff on imports from China. The US dollar index rose 0.65%, which would be its biggest rise in a day since January the 2nd. That saw the Aussie dollar fall 0.8% to 62.52 US cents and the Kiwi fall 0.9% to 56.45 US cents. Meanwhile, the Nasdaq, that's down 0.9% after Nvidia's earnings were disappointing, and the S&P 500 is down 0.3%. All this worry about inflation has meant the US 10-year yield is up 3 basis points to 4.28%. Meanwhile, markets await key US personal consumption expenditure data on inflation in the United States later tonight, which is the Fed's favourite data point. But as ANZ head of G3 Economics Brian Martin says, the prospects of tariffs raising prices is looming over everything in the world's largest economy, which means inflation could remain sticky for the foreseeable future.
And that plays into the view that the Fed is on hold for the time being. Indeed, our view is that the FOMC will not be cutting interest rates now until the second half of this year. We do think, though, that consumers are very sensitive to price increases, and that if significant tariff increases come through in consumer goods, the likelihood is that you would see an offsetting fall in demand, and ultimately that's going to constrain the inflationary impact from tariffs.
Number 2. ANZ's New Zealand Business Outlook survey for February showed headline business confidence rose 4 points to 58. However, ANZ economist Sharon Zollner says the situation remains mixed for an economy starting to turn out of last year's recession.
The past own activity measure actually dipped 3 points as well, while past employment was flat at 7. So overall, I think the picture continues to be that times here and now are still quite tough, but firms are quite optimistic about the future, and times are certainly better than they were 6 months ago. Those past activity measures are well off their lows for every sector of the economy, which is really encouraging. But based on the short history we have for this data, you wouldn't say that things are looking strong.
Number 3. Sharon says there was generally good news for the Reserve Bank of New Zealand in the survey's price and cost gauges.
We saw a small dip in the proportion of firms expecting higher costs, for example. Inflation expectations dipped a little bit as well, but there was quite a jump in manufacturers' expected costs and actually in their expected pricing as well. That might be related potentially to hikes in electricity prices that we're seeing at the moment. The weaker New Zealand dollar might also be playing into higher import costs. So there's still a few little pockets of high costs, and certainly not all of those measures are back where they need to be. But overall, I would say a good month for the Reserve Bank in terms of the moves in these indicators.
Number 4. Another component for Australia's Q4 GDP numbers came in weaker than expected yesterday, with private new capital expenditure falling 0.2% in the quarter, compared to a market consensus for positive 0.5%. ANZ senior economist Adelaide Timbrell says the important GDP component of machinery and capital expenditure fell 0.8%.
This is a little less than we expected to see in terms of activity. Now, part of the reason for this smaller result than expected is because we saw an upwardly revised level of activity in Q3. So the fall looks worse than it is because the data was revised upwards for the quarter right before. But the important part of it is that we've seen a fall in machinery and equipment capex, which means our Q4 2024 GDP forecast has downside risk. We've retained the call at 0.6 quarter on quarter, but the risks are now balanced to the downside.
Number 5. Adelaide says there was also a weak start to 2025-26 capital expenditure plans, which were up only 2% from the current financial year.
Now, part of this is because there was a stabilisation in costs after a period of stronger inflation. And because it's nominal expectations, so it's the expectations of dollars rather than real activity, those price changes do have an impact. But uncertainty around global trade and its impact on economic growth could be a factor here. And there does seem to be persistent weakness in businesses being able to look ahead and take that risk in terms of capital expenditure.
Adelaide Timbrell there. Now, in our bonus deep dive interview, ANZ Economist Maddy Dunk tells my colleague Alex Tarrant that Australia's housing market might not get much of a shot in the arm from the RBA's start to rate cuts.
I think there's been a lot of talk around rate cuts. What kind of impact a rate cut is going to have on Australia's housing market? Are they going to move us out of this slowdown? And the thing to remember is that we're only expecting 2 rate cuts in total. So just one more rate cut can indeed, if you listen to the RBA's rhetoric, they're not in any hurry, but they're very hawkish in their tone. Now, because we're only expecting the 2 rate cuts, so a very shallow easing cycle, we don't think that it's going to have an immediate impact on housing prices. And indeed, we think that it's going to have a reasonably modest impact on housing prices. If you look at historical easing cycles, at times when house prices have been falling, it's taken a while for housing price growth to actually pick up. So if I think about 2008 or 2011, where housing prices had been falling and then the RBA started cutting rates, and indeed those easing cycles were more aggressive than the one we're likely to see play out this year, it took around 4 or 5 months for housing prices to actually turn around. And we think it's going to be pretty similar this time, that it's not going to be an immediate jump in housing prices. It's going to be a slow grind. It's going to be due to the fact that real household incomes will be lifting, also some of those supply-demand dynamics shifting, and that affordability story is going to be something that does weigh on house prices.
And so which states should we be watching, or which capital cities and which states should we be watching?
Well, I think there's a lot of interest in Melbourne's housing market at the moment, given that it has led the downturn here in Australia. We've seen Melbourne prices have been falling 10 months in a row, and that's been led by the more expensive properties. So one of the things to watch will be those more expensive properties. They too tend to lead the cycle. So they are generally the largest to fall and the first to fall, and often the first to start picking up. So that will be a good leading indicator. I think in terms of what we're likely to see across the different capital cities, we're expecting places like Sydney, Melbourne will start picking up in the second half of this year. But given the weakness we're likely to see in the first half of the year, it does mean we're expecting price falls in Sydney and Melbourne this year of roughly 1%. Looking at some of the other capital cities like Adelaide, Perth, Brisbane, for example, which have all recorded very strong price growth recently, we do expect that the pace of that will continue to wane. And we've got far more modest increases in those housing prices this year compared to last year. So around 3.5% in Brisbane and Adelaide, and roughly 5% in Perth this year. And then one of the other ones that's quite interesting is Canberra, because we have seen quite a bit of weakness in the Canberra housing market as well. And I think a lot of that is a supply-demand story. If you look at the growth in population versus the growth in the dwelling stock, what we've seen is that dwelling stock has grown at a faster pace than population. So in other words, what that means is that there's more supply than demand coming into the Canberra market. And because of that, we do expect a 2% fall in Canberra prices this year.
Maddy Dunk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, February the 28th. Catch you next week with analysis of what tonight's US PCE inflation data could mean for the Fed's rate path. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.